Investment is made with the expectation of making gains in the future. For this, investment demands sacrifice of current consumption of money value. Also, one of the most important characteristic of future is the uncertainty involved in it. Since investments are linked to the future, it also encompasses its element of futurity. The uncertainty induces the risk factor. Risk can be defined as the probability of loss in the expected returns, that is, the realized returns will be less as compared to the expected returns. The expected return is the random future return that an investor expects to earn from the investment he holds. On the contrary, the realized return is the return actually obtained from the investment at the end of the holding period. The actual return is not always same to the expected return. This prospective variation of the actual realized return from the expected return is what we call as risk. The wider the leeway for possible outcomes, the greater will be the risk. In other words, the instruments whose return fluctuates significantly are considered to be high risk investment instruments. For example, equity shares, and the instruments whose returns are fairly stable are considered to be low risk investment instruments. For example, government treasury bills. After studying this module, we shall be able to understand the concept of risk, explain different types of risk, differentiate between systematic and unsystematic risk, learn about the measurement of risk, calculate systematic risk. Now we are starting with the types or elements of risk. The variations in the expected returns of an investment are caused due to a wide variety of factors. These factors constitute the element of risk. These elements of risk may be broadly classified into two groups or sources. One such group is composed of factors that are basically attributable to the economy or market. These factors are external to the companies and uncontrollable in nature. These affect all the companies and a number of securities simultaneously at large. This group is basically pervasive in nature. This group of factors induces the systematic risk. The other group consists of those factors which are internal to the companies and specific to particular security issue. These are controllable to a great extent. The risk produced by this group of factors is referred to as unsystematic risk. Thus, the total risk of an investment is composed of two components, systematic and unsystematic risk. Now we have security analysis and portfolio management. This comprises of total risk. Total risk is a combination of systematic risk and unsystematic risk, that is general risk and specific risk, or in other words we can say that market risk plus unique risk. Now we are starting with the systematic risk. Systematic risk is the non-diversifiable portion of the total risk. Such risk is attributed to the overall economy-wide factors that affect the pricing of all securities and companies in general. These risks are unavoidable and uncontrollable in nature. Systematic risk causes variations in the return due to movement in the general market. Because the market is inherently unpredictable, the systematic risk always exists in all investment avenues. This portion of the total risk cannot be reduced through diversification. This type of risk accounts for most of the risk in a well-diversified portfolio. The systematic risk can be of different types. Some of are listed below: interest rate risk, market risk, and purchasing power risk. We start with discussing interest rate risk. Interest rates account for a major part of the systematic risk in investment activities. The variability in the securities expected rate of return that is caused due to the fluctuations in the interest rates prevailing in the economy is called interest rate risk. These changes in the interest rates are either on account of regulatory framework or market forces. Since the expected return on an investment rises due to an increase in the general interest rates or decrease in the general interest rates, or the market prices of the securities happen to fall and vice versa. In other words, other things being equal, the security prices move inversely to the movement in the interest rates. Fluctuations in the interest rates have a more direct bearing on the bonds and other fixed income securities. Effects on common stocks or equities are somewhat indirect. The second risk is market risk. The market price of shares tends to fluctuate consistently in different time periods. The general rise and fall in the market share price is commonly referred to as bullish and bearish trends respectively. These movements can be easily seen in the market indices such as Bombay Stock Exchange Sensex, NSE Nifty and etc. While the phases of ups and downs in the share prices in the long run can be considered as a result of business cycles, the short-term fluctuations are mainly because of changes in the investor psychology. These changes in the investors' expectations are a result of their reactions to the tangible and intangible events in the economy such as fall of government, sudden change in monetary policy, emotional instability and investors collectively leading to the market. Then we have risk types and its measurement. We have investors' reaction and overreactions to this. Now third we have purchasing power risk. Purchasing power risk or inflation risk is yet another type of systematic risk. The loss in the purchasing power of money caused due to inflation also affects the returns from holding an investment. When an investor holds an investment, he makes a sacrifice of the current consumption of the money value. That is, he postpones his consumption. On the same hand, if there is inflation in the economy, the price of goods and services would rise, leaving the investor with a reduced purchasing power of the money left with him. Thereby, the investor actually experiences a decline in the purchasing power of his investment and the return from that investment. The important types of inflation are the cost push inflation caused due to the rising cost of production and demand pull inflation that occurs when the demand for goods and services is in excess in relation to the supply. The purchasing power risk is also related to the interest risk as the interest rate rises when inflation increases. Now we move on to unsystematic risk. The unsystematic risk represents such component of total risk that arises on account of company-wide factors. These risks are firm-specific and are also called as unique risk. These factors peculiar to a company or industry are, for example, labor strike, development of a new product, management inefficiency, emergence of a new competitor, etc. This risk can either be reduced or eliminated completely through diversification in a well-diversified portfolio. The well-diversified portfolio, the unique risk of most of the stock tends to cancel each other, resulting in minimum non-market risk. The unsystematic risk can be classified into the following: business risk and financial risk. Business risk arises on account of the operating conditions of the economy. These operating conditions include both the internal environment, that is conditions within the firm, and external environment, that is conditions outside the firm. These operating conditions influence the performance of the company and are reflected in the operating cost of the firm. The operating cost is the aggregate of fixed cost and the variable cost. A large portion of the fixed cost is risky for the firm as it increases the business risk. In other words, a decline in total revenue of such a company would result in more than proportionate fall in the operating profit. This is known as operating leverage. The external environment conditions which are beyond company's control, such as changes in government policy, unforeseen market conditions, strategies of competitors, may cause external business risk. Internal business risk is related to the efficiency with which a company operates. Some internal business risk factors include raw material scarcity, labor strikes, fall in production, etc. These are within the company's control. The business risk is thus the variability in operating income caused by operating conditions of the company. The second unsystematic risk is financial risk. Financial risk is associated with the financing pattern adopted by the company. The debt component of capital structure demand fixed payment to be made in the form of interest irrespective of the fact whether the company makes profit or loss. This fixed interest payment may cause variations in the earning per share of the equity shareholders. Higher the debt, higher the degree of financial leverage, which may have an unfavorable effect on the earning per share. In the worst cases, it may lead to the capital erosion of the company. Thus, a company with high financial leverage incorporates high financial risk and vice versa. This risk is, however, within the control of the company, as the company is independent in its financing decision, that is, it is free to finance its activities without resorting to debt. Thus, financial risk is the variability in the earning per share due to the presence of debt component in the capital structure of the company. Apart from systematic and unsystematic risks, we have other risks, etc. And for example, these risks are may termed as controllable and uncontrollable. These may vary in the form, size and effects. Some of the identifiable risks are listed below. First is political risk. It arises out of political conditions prevailing in the country. The variability in the returns of the asset caused due to the legislative, judicial and administrative branches of the government is called political risk. It is also called as country risk. The second is management risk. It is the loss of company caused due to inefficiencies or errors of the management. The third is the default or insolvency risk. The variability in the assets return that results from the financial integrity and creditworthiness of the firm is called default risk. Then we have liquidity risk. The risk associated with a particular security market in which it is traded is called liquidity risk. The more the uncertainty about time element and price concession, the greater the liquidity risk. And we have foreign exchange or currency risk. Foreign currency risk or currency risk arises out of investments made internationally. The prospects of uncertainty in the returns after they convert their foreign gains back to their own currency is called foreign exchange risk. Now we move on to the measurement of risk. Every financial decision involves risk. For making effective financial decisions, it is necessary to understand the kind of risk likely to be faced, estimate the extent of risk corresponding to different investment alternatives, and know the effects of risk on the investor's expected rate of return. For this, we need to measure and quantify the risk associated with each investment proposal. Risk is the extent of variations in the expected return. Thus, it is associated with return of an investment. The risk of an investment in isolation cannot determine the investment decisions. Another factor influencing the investment decision is the expected rate of return by an investor. The return in turn depends upon the cash inflows to be received from an investment. It is the aggregate of yield and the capital appreciation. Thus, the return and risk of an investment form the base for any investment decision. Suppose that the investors are able to assign profitability to each possible return likely to occur from an investment. A probability distribution can now be drawn for these possible rate of return. A probability distribution is the list of all possible returns from an investment with their respective probabilities attached with them. For example, the following table is the probability distribution of all possible returns assessed by an investor that are likely to be received from an investment. For example, if returns are 11%, then it is probability to be achieved rate of return 0.10. And if the returns rate is 12%, then the probability to earning per share is 0.20. If the returns are 13%, then probability may be 0.40. If the returns are 14%, then probability is 0.20. If the returns are 15%, then probability may be 0.10. The probability distribution shows that various returns are associated with the risk. The table can be used to extract two simple statistical measures, that is summary statistics, for the purpose of benefiting the investment decision to be made. These measures are expected return from an investment and the risk of the investment. We have used here two terms, expected return and risk. The expected return can be defined as weighted average of all possible returns from an investment using the probabilities as weight. For the table, we have earnings expected return is equal to 11 multiplied by 0.10 plus 12 multiplied by 0.20 plus 13 multiplied by 0.40 plus 14 multiplied by 0.20 plus 15 multiplied by 0.10. This gives us rate of 13%. In general, the expected rate of return can be calculated with the formula, that is expected return is equal to R1 P1 plus R2 P2 plus so on indefinite Rn Pn. This can be written as expected return is equal to sigma from time 1 to n is equal to RT multiplied by Pi, where expected return is equal to expected return on security I, Ri is equal to possible return on security I, and Pi is equal to probability oblique weights. In other words, the expected rate of return is the summation or product of all possible returns with their respective probabilities. The expected return from the probability distribution in table is equal to 13%. The second term used was risk. In this above example, the probability of different possible outcomes from an investment itself depicts the presence of risk in the investment. Had there be a perfect foresight of an investor, there would have only one possible outcome with no probability distribution. This shows that the risk is related to the dispersion of distribution. A number of measures of distribution have been developed by statisticians such as range, mean, absolute deviation and the variance. Among the most popular and useful is the variance or standard deviation of the probability distribution of possible returns. Variance is the square of standard deviation and is depicted as variance square. We use this measure of dispersion to represent the risk of a single investment. The risk of an investment is the weighted average of the square of each possible returns deviation from the expected return. Again, using the probabilities as weights, for the above example, we have variance square is equal to 11 minus 13 whole square multiplied by 0.10 plus 12 minus 13 whole square multiplied by 0.20 plus 13 minus 13 whole square multiplied by 0.40 plus 14 minus 13 whole square multiplied by 0.20 plus 0 gives us 1.095 as standard deviation. In general, variance is calculated as variance square is equal to R1 minus expected return 1 multiplied by whole square multiplied by P1 plus R2 minus expected return of the second probability whole square multiplied by P2 plus so on Rn minus expected return of the nth item of probability distribution whole square multiplied by Pn. This can be written as variance square is equal to sigma T is equal to 1 to n multiplied by Ri minus expected return of I probability distribution whole square multiplied by Pi, where the variance square is variance or risk on return security I. Ri is equal to return on security I. Expected return of I is equal to expected return on security I, and Pi is equal to probability or weights assigned to it. In the above example, mean measures the expected value and the variance or standard deviation is used to measure the variability. Thus, the approach of measuring risk is also referred as the mean variance approach. Now we have measurement of systematic risk. The variance or standard deviation measures the total risk of an investment. The total risk is, however, composed of two components, that is systematic and unsystematic risk. Unsystematic or unique risk is the risk associated with a particular security of a company. These are firm specific and can be reduced or eliminated by combining it with other security opposite in nature. This is called diversification. The unsystematic risk can be reduced to zero if the securities are perfectly negatively correlated, since it can be reduced through diversification. It is considered as irrelevant risk for investors. The investors now need to measure the undiversifiable part of the total risk, that is unsystematic risk. It is the risk which relates to the economy-wide factors. All the securities are affected by these market changes to some extent or the other. The greater the variability of securities return in return to the market changes, the greater is the systematic risk. The measure of systematic risk is beta. It is a measure of sensitivity of the securities return to the movement in the market. The historical data for securities return and the return of a representative stock market index are used for calculating beta. Mathematically, beta is equal to RIM, variance I, variance M divided by variance square M. This is equation 3, or we can write it as beta is equal to covariant of Im divided by variance square for M. This is equation 4. In this equation, we have small RIM shows coefficient of correlation between return of stock or return of the market index. Variance for I is equal to standard deviation of stock I. Variance M is equal to standard deviation of the return of market index. Variance square M is equal to variance of the market returns, and covariant of Im is equal to covariance of the returns between security and market index. Now we have the summary of what we have discussed so far. Risk is the probability of loss in the expected return, that is, the realized returns will be less than the expected return. It is measured through variance or standard deviation. Total risk is a combination of systematic plus unsystematic risk, or in other words we can say total risk is equal to market risk plus unique risk. Systematic risk is the non-diversifiable portion of the total risk which is attributable to the overall economy-wide factors affecting pricing of securities and companies in general. Interest rate risks or market risk or purchasing power risk are types of systematic risk. Unsystematic risk arises on account of company-wide factors, firm-specific factors. These can be eliminated through the process of diversification. Next, we have discussed the types of unsystematic risk. They are business risk, financial risk, etc. Then we have political risk, management risk, default risk, liquidity risk, foreign exchange risk, etc. are different types of unsystematic risk. We have also studied expected return. Expected return on investment is the summation of product of all possible returns with respective probabilities, and mathematically they can be written as expected return is equal to sigma t is equal to 1 to n, and it is we have Ri and multiplied by Pi. Next, we have studied the risk of an investment is the weighted average of the square of each possible returns deviation from their expected return, again using the probability as weights. Mathematically, we can write it as variance square is equal to sigma t is equal to 1 to n within bracket Ri minus expected return of the I probability distribution whole square multiplied by Pi. Then we have discussed mean measures the expected value and the variance or standard deviation measures the variability. This approach of measuring risk is also known as mean variance approach. After that, we have studied beta. Beta is the measure of systematic risk. It measures the sensitivity of the securities return to the movement in the market. Mathematically, it can be written as beta is equal to RIM variance I variance M divided by variance square for M, or it can be written as beta covariance Im divided by variance square of M.